So what type of returns do you get when you invest on the Zimbabwe Stock Exchange? I'm going to answer that question in this video. Now, from the onset, I'm going to say that this video is going to be about investing in equities or investing in shares on the Zimbabwe Stock Exchange. I'm not going to talk about fixed income. I'm just going to limit our discussion to shares, which is what most people who are participating on the Zimbabwe Stock Exchange are buying. So there are two ways in which you'll be able to get money when you invest in shares on the Zimbabwe Stock Exchange. The first one is dividends, and the second one is what we call capital gains. I'm going to start with dividends. So dividends are essentially money that is paid out to investors out of the profits that are declared by the company. So back up. How do dividends come about and how much are they? So here is what happens. A business has been run throughout the year. Econet, it has had its year, a fantastic year, and it has made $2 billion in profits. That's amazing. $2 billion. Who owns Econet? It's you guys, the investors, the people who have shareholding in Econet, you and Strive and many other pension funds and many other, businesses or investor clubs in Zimbabwe that actually do own Econet. These are the people who own Econet. So when the $2 billion is declared out and say, we have made $2 billion, the board of Econet sits down and they have to decide how much of that money goes back to you, the investors. Well, let's just assume for simplicity purposes that they say, we are going to use $1 billion to plow back into the business, to reinvest in the business, and we're going to give our investors $1 billion in profits. Well, we have to figure out a way in which this money is actually given out to people. Let's also assume, I'm sorry I'm making so many assumptions, but let's also assume that Econet has 1 billion shares outstanding. If we have $1 billion that's being paid out and there are 1 billion shares outstanding, I think my mathematics tells me that every share is getting $1, which means that at this point this year, investors who are investing in Econet, who are invested in Econet, are getting $1 per share. If you have 100 shares, then you are getting $100 in dividends that year. So dividends usually are paid yearly, as you have already inferred from what I'm talking about. And there's one other nuance though, which is the ex-dividend date. The interesting thing is that when the dividend is declared, as you might realize, other people might quickly rush to buy shares because they want to harvest this dividend, because the dividend is announced and they say it's going to be paid in 3 months or something like that. They don't just announce and say we're paying it tomorrow. They are lag time. But what happens is that to make sure that some people don't try to take this opportunity to rush in and buy shares so that they just harvest the dividends and sell the shares afterwards, what they do is that there is a date which is the last date which they will consider. So the share register, which is kept by the company's transfer secretaries or kept at the company's offices, it is updated daily based on who has bought or sold any shares. So they say today is August 1 and we are going to pay $1 per share for people who are owning shares as at July 23, which means that they're going to pick up a day in the past so that you cannot then just rush and go and buy the shares. So already they will pick up a day in the past and they say, if you are owning the shares as of this date, then we're going to pay you. We don't care whether you have sold the shares, whether you still have them, you're going to be paid because you were the shareholder of record as of that date. So this is something that is a nuance that other people might just need to understand on this issue of dividends. But of course, as I have said, the math is simple. The board sits down, they have declared a profit, and they figure out what percentage of their profit they're paying out to investors. When they figure out that percentage, the profit is 1 billion and there are 1 billion shares outstanding, it's simple math. 1 billion divided by 1 billion, which is $1 per share. But of course, it could be $500 million of profits divided by 1 billion shares, which in this case would reduce the dividends to 50 cents per share. Of course, it's just an issue of mathematics, but this is entirely everything that I think you need to know on a surface level, what you need to know about dividends. They are paid yearly, and this is money that the board decides is not going to be reinvested into the business, and they are paid as of a certain date to make sure that investors don't rush in to buy companies that are declaring dividends. The second thing that you get for owning shares is what we call capital gains that you make when you sell your shares. So imagine today you buy Econet at $2 per share, and then after 3 months, this company rises and investors really think it's a good company and they keep buying it, bidding up the price, and it's now $10 per share. you have made capital gains of $8. Your money has grown from $2 to $10 for every share that you sell. When you sell this money, this $8 is your money because you have been holding this security and taking this risk of owning Econet. And so that's the money that you get when you buy low and you sell high, and it's a capital gains. Of course, for the other video that we made about costs of investing on the Zimbabwe Stock Exchange, we talked about the capital gains tax which you get charged for having made this gain. But this is the second way in which you gain by earning your shares. But this way, of course, as you can see, it's only something that you can gain after you sell the shares. If you're an investor who intends to keep all the shares, then the only way that you're going to be earning from your money back is going to be waiting for the dividends to come back. So just to bring everything together, guys, if you are an investor who is looking for the long term, you are definitely thinking and you're definitely looking at dividends as your way of earning money. These are going to be your primary ways in which you get a little bit of returns on your capital as you deploy it in capital markets in Zimbabwe. If you are someone who is either a speculator or an investor who is just wanting to get in and out and making bets on companies based on timing and based on some other factors, whether you're betting on the macro economy or you're betting on individual companies, then you're looking at possibly a combination of dividends and capital gains. But of course, as I have said, the dividends that you get will depend on whether you are actually a shareholder at the date at which the share register is accessed for the purposes of determining who is getting a dividend. If you have any question on this topic that we have covered as to how your money actually then gets turned back to you as you deploy it in capital markets in Zimbabwe or as you deploy it on the Zimbabwe Stock Exchange for the purpose of buying shares, do let me know in the comments below, and I'll be happy to try to figure out a way in which I can answer it either in the comments or by making another video if I think that other people might benefit from hearing an answer that I'll be giving to you. But until next time, my name is Maro. See you then.